Hello everyone and welcome. I am today with Alexandre Drabowicz, CIO of Suez. We are here to talk about markets and economies. In their fight against persistent inflation, central banks kept a restrictive monetary policy in 2023. And as we enter the fourth quarter of the year, we have key rates that are at record highs, 5.25 in the US and 4% in Europe. And both central banks have vowed to remain data dependent over the coming month. In this context, what is our main scenario in terms of interest rates for the end of the year and for 2024?
To answer your question, as far as the Federal Reserve is concerned, after 11 hikes in a row, I think they are done. In a way, the job is done for Mr. Powell. From here, they maintain a very hawkish tone. And I think there is a strategy here to maintain expectations that they will not cut rates too fast. It is our expectations, however, that in the course of 2024, more in the second half of 2024, they can have the capacity to reduce interest rate by 75 basis points. As far as the ECB is concerned, 4%, they're also done. However, we think they are in a different situation in terms of fighting inflation, and it is unlikely that they will be able to cut interest rates for 2024. So for the ECB, it's a much more prolonged plateau at 4%.
We are seeing this in yield curves. Actually, long-term yields have gone up, and we have the 10-year US typically crossing the 4.5% mark, a level we have not seen since 2007. So in this context, how could you explain the rise in interest rates, and what is the risk for financial markets?
So indeed, we've actually reaching close to 4.85 today. I see two reasons actually to explain this move. First of all is the resilience about the US economy. Remember, we started the year, we were convinced that we would have a US recession, that it was unavoidable. But in fact, we're going to end up 2023 at about 2% growth. So this, of course, has to be reflected in long-term interest rate. The second reason is about supply. Back in June, when we had the debt problem issue that was locally solved, US debt was at $30 trillion. We are today, early October, at 32 trillion. So the US is running a huge fiscal deficit, and the US Treasury has to issue a lot more debt with long-term maturities. And as a result, the supply is coming to the market, and investors who are willing to buy US debt are basically asking for a higher premium, which is reflected in higher interest rates.
Obviously, these long-term rates are also about to have an impact on investment decisions. Do you think now is the right time to increase duration in the portfolios and to lock in and take advantage of these high interest rates?
So it was our strong conviction since the start of the year to avoid investing in a long-term part of the bond market. There was definitely a risk of a repricing. Today, it's also our conviction that we need to take advantage of the inverted yield curve, the fact that the yields as of today are higher than the ones in the future. Typically, we are more in a favor today to lock in this level of interest rate up to 5 years. So we will recommend to invest into bonds up to 5 years maturity, but not necessarily going beyond this type of maturity for now.
What about equities? Long-term rates pressure valuations and pose risks on equities as well. So what is our view in terms of geographical allocation?
Indeed, equities are really affected today, particularly companies that are either unprofitable or companies that are running with long-term financing that directly impact their projects and their business. On the other hand, companies that are profitable, companies that have a good level of growth, in a way are immunized from this situation today. So there is some stock picking actually to put in place in portfolios. As far as geographical allocation is concerned, to answer your question, we favor US equities. For us, it remains the leading market, but we like to have a kind of barbell strategy. On the other side, also to own emerging market equities. In our view, they are very, very cheap. They are under-owned globally by international investors, and more importantly, they offer very strong growth prospect, both from a profit point of view, but also from a GDP point of view. Overall, world GDP is mostly coming from the emerging market world, which for us is still unavoidable.
Thank you, Alex.
Thank you, Christiane.